Hello and welcome to the Ditto educational series that will provide you with the skills you need to become a forex trader. Today we are going to be talking about entering and exiting trades using a technical analysis based method that is one of many tools that can be used to identify a precise entry or exit point in any given trade setup. We have discussed many of the subjects surrounding trading in the beginner series, but not how to identify exact entry and exit points with any given tool. Today we will look at the Fibonacci Retracement tool and its practical function when analyzing the markets. Firstly, let's discuss the background of the tool itself. The Fibonacci sequence reflects patterns of growth spirals found in nature. There is an underlying geometry in the evolution of living things that the Fibonacci sequence of numbers identifies in. The Fibonacci sequence is found in music, art, nature, and biology, and seems to almost be a measurement for life itself. This is a very deep, intricate subject that I could produce its own series of videos on, but let's skip ahead to how. How does this apply to Forex, and how can we determine our trade entries and exits using this sequence of numbers? In order to answer this, we must look at the Fibonacci Retracement tool and its application. Fibonacci Retracement is a term used in technical analysis that refers to areas of support or resistance. Fibonacci Retracement levels use horizontal lines to indicate where possible support and resistance levels are. Each level has an assigned percentage, and these percentages reflect how much a prior move the price has retraced and are Fibonacci sequence numbers. The Fibonacci Retracement levels are 23.6%, 38.2%, 61.8% and 78.6%. There is a 50% level which is also used but is not a Fibonacci number. This indicator is used by drawing it between any two significant price points such as a low and a high, and the indicator will show the levels between those 2 points where the percentages apply. Basically, we are looking to trade the retracement of price using these percentage level as one or more entry points with a high degree of accuracy. Retracements occur because when the market is trending and gaining momentum, some traders will take profits, which results in a small sell-off forcing the price back down slightly until the original momentum returns, resulting in a continuation. So, firstly we need to identify a strong uptrend and then look to enter during the formation of the pullback. We can draw our retracement from the swing low to the swing high. We always start with 100% and draw it to 0% as we are looking to measure the increasing percentage of the pullback. The most popular percentages are 38.2%, 50%, and 61.8%. 61.8% is the most prolific number in the Fibonacci sequence, as many of the numbers divided by the prior number equate to this value, but 50 and 38.2 are just as regarded. We could also highlight the entire area as an entry zone for a buy or sell. Once we have drawn in our retracement tool from the low to the high, we can now begin to strategize about potential entry points. We have our 38.2%, 50% and 61.8% lines. So using the market prices given, we could place, for instance, a small pending order at each percentage. This would offer us the best possibility at least catching one of them before the continuation of the trend. There is no telling how far the market will retrace, however the accuracy of these measurements will make most new traders look at you like you have just invented fire. When you are shown for the first time, it's really incredible when you look over historical data how much this method has paid off for pinpointing entries versus how many times it has failed. Fibonacci is applicable in any time frame and absolutely defines the market price in some larger scale analysis. Here are some examples of where Fibonacci has accurately predicted entry on multiple occasions. Here we see, over and over again, we are given entry after entry by this remarkable tool. Now, is the Fibonacci Retracement technical analysis tool, which is regarded as the formula of measurement for so many aspects of life, a magic and mystical secret to trading the forex markets? Not exactly. Although it is widely regarded and factored into market participants' decisions making, perhaps the reason for its reoccurring accuracy is that traders and automated trading systems read the market and trade the market the same way. If everyone is using the same ruler, then we can expect the same results. What I mean by this is if an upward trend price starts to retrace and generally the majority of market participants are expecting to buy in at one of the three pre-mentioned levels, then we can expect the continuation of the trend to continue from one of these 3 points. Psychology and shared knowledge play their part here, and we are trading in a way that anticipates the market participants' thought process. I believe we have covered this aspect reasonably well, so let's move on to exiting our trades. Whether we are exiting our trades via stop losses being triggered, usually this is due to the markets behaving differently to our analysis, or we are looking for reasons to exit our active trades, knowing when to exit or having strategy surrounding exiting our trades is imperative to preserving profits. Now this video is about Fibonacci strictly speaking, so let's discuss at which point we could think about placing our stop losses or exiting our trades. If we are placing 3 entries at our levels of 38.2%, 50% and 61.8%, then we could set our stop losses beyond the 78.6% level. This would give our trades enough room to breathe and be reasonable stop losses in terms of our analysis not making sense anymore. However, if our trades are all triggered and go on to continue to profit with the trend, where should we place our next stop loss? If we adopt a trailing stop loss method, the answer would of course be just beyond the next established higher low, in accordance with the price action, and more than likely it would fall just beyond the 78.6% value level. In accordance with our risk-reward educational videos, we know that we are looking for at least a 1:2 ratio of risk-reward, and your lot sizes should be calculated for percentage of account risked between entry and stop loss. Please see our pips and lots video for more information regarding this subject. In summary, Fibonacci Retracement is a powerful technical analysis entry tool. We have seen its application and reliability, and together with everything in this beginner series, you now have a very broad understanding of the forex markets and are more than ready to trade on a demo account. I hope you will go on to refine what you have learnt, and I hope you have enjoyed our video today, ladies and gentlemen. Please open your charts at home and start applying Fibonacci to current and previous market charts. Practice makes perfect, and remember, contemplation is the key to learning. Thank you for watching the video. If you enjoyed our educational sessions, then please like and subscribe.